Welcome to episode 168 of Wealth Talk. My name is Christian Rodwell, the Membership Director for WealthBuilders, and I'm joined today by our founder, Mr. Kevin Whelan. Hello, Kevin.
Wow, Chris, what times, eh? U-turns, I don't know. You think you can plot your way through the financial storm that's been raging, and all of a sudden, the government itself blows the wind 180 degrees from where it was before. A complete volte-face. A turnabout. I remember doing a presentation with a group, Chris. We must talk about community, very powerful. And I said, are we into another area where, I don't know if you remember, there's a quote from 1980. You're much too young to remember it, Chris, but when we had the last winter of discontent, and as we hit October now, I was kind of theming my talk as if it's like we've got a new winter of discontent on its way. Have we got a new lady, as Margaret Thatcher was in around 1980, 78 when she came to power, who said, you can turn if you want, but the lady is not for turning. And I thought, we've got another one. But within a couple of days, we've changed completely. So the 45p tax that was abolished has been reinstated. There's egg on the faces of the government. And how on earth are we supposed to plot our way through our wealth building life in the long term when the short term is so completely wacky? I mean, I think we should talk about that today, Chris.
I think so. I think it's a good time for a reminder of the very robust model that we operate here at Wealth Builders, which is our 7 pillars of wealth. And the more pillars that you can build, the more assets that you can have generating recurring income streams for you every month, then the more peace of mind, the more security, hopefully that provides in your life. So today we're going to take a bit of a whirlwind tour through those 7 pillars for anyone perhaps who's a new listener, hasn't heard us talk about those in detail before, and just look at obviously the times we're in now, Kevin, and what should people be focusing on right now for each of those pillars, and of course looking forwards at the opportunities.
Yeah, but I also want to say, Chris, not about just new listeners who may well have not discovered the principles of wealth building with assets. And just to say that an asset is the only way to build wealth, or assets. And an asset is something that you own that is not you, puts money in your bank account while you're asleep. That money can be passed on to your family in good causes as you choose. The money basically carries on showing up even though you're not you. So in other words, the money continues even if you're not there. Now they're the principles, but for seasoned listeners who've been around a long time, who maybe even know the pillars by now, Chris. I bumped into one of our members recently and said, can you tell me the 7 pillars? She got 6 out of 7. I was very pleased about that. And but I think it's worthwhile touching on maybe 1 or 2 ideas that even our seasoned listeners could pick up. So if you've listened before and you're hearing, 7 pillars, I know them, don't switch off, because every time you make a new distinction, it opens up a door and clears a pathway to build more wealth. Let me say that again, Chris. The power of creating wealth is the power of making distinctions. And those distinctions move you. Right. And I'm going to just jump on a little reminder. I can't remember the last time I did this one, Chris, that in the context of building wealth, you're in one of 3 spaces. You're either in the retail space where the wind's blowing on you, you're paying full price for everything, you've got no control over anything, and basically your life is just being pushed and pulled in different directions. And for the most part, that's the 95% of the population. That's the people who don't make it. Those who are taking action are moving, and that movement is to wholesale. And that's wholesale means making distinctions, creating niches, finding niches. This word niche is critical because opportunities exist in niches. They don't exist in markets. That's why it frustrates me, Chris, when people say, what do you think of the market? I go, well, there is no market. You find your own market by creating niches. Okay, so there's no one market for anything. It's if you're asking questions about the market, it means you're thinking like a retail customer, which is the worst place you can be. Once you move from the niche, you determine the strength of where you're going. In other words, you hone your skills and move towards being a creator. And creator in the sense that you're creating your own market, that your own marketplace, that you are now master of, your domain is there. It means you can survive, thrive, grow exponentially, irrespective of the state of the market. You see what I'm saying? So, in other words, we are in control of our own personal economy. The economy's out there, but we are in control of our own. And I hope to share as often as we do, Chris, not just me or you, but our members and our listeners, distinctions that they are making and they're finding to help them carve a better path by being in control and being proactive, rather than, what did we say in the debits challenge recently, Chris, when we talked about just getting people to focus for a short period of time on doing something proactive. It's the proactivity that's the key. And people are starting to find savings they thought they couldn't find, right? So we know this is true when you spend some time being proactive, and it helps. This is why the community point again, Chris, and maybe we can save that for pillar 7. But the whole point about community is the strength of the distinctions that are made by so many other people who are not you, and therefore think differently to you, look through a different set of eyes and lenses than you do. And they'll find things for you that being on your own and isolated simply will never do.
Yeah. And we certainly acknowledge that, there are genuinely difficult times out there at the moment for some people and ahead. And so rather than completely shut down and think that it's not possible to build wealth, we just obviously want to continue to share ideas so that people can take small steps throughout, the period ahead.
And what's interesting, Chris, these steps that can be taken at any age. It doesn't matter whether you're 18 or 58 or 68 or 78. It doesn't matter. There are always small steps you can take, because a lot of people, again, they'll say, "Oh, the marketplace, it's too difficult," right? And therefore shut down. The other thing is sometimes we'll have people saying, "Oh, I'm too old," or "I'm too young," and that's a challenge. So I think what we want to do is highlight what people can do at all ages.
Yeah. So should we first begin by just summarizing the 7 pillars as a refresher? And we kind of put pillars into two sides, don't we? If you're looking at a piece of paper, say the Wealth Builders logo in the middle, and then on the right hand side we have pillars 1 to 3, which is home capacity, pensions, and investments. And we call these the traditional pillars, Kevin.
Well, we call them traditional because that's where the 95% of the population look to build their wealth. They don't necessarily deliberately think of them as pillars, let's say. I think they're more accidental. There's the plan to live in a home at some point, and we know there are renters out there as well, but let's say the vast majority of people want to have a home in the security of that. Certainly in the UK, they will have some form of retirement plan, usually either set up personally or through a company, and they'll have some money in a marketplace somewhere, whatever that marketplace is, and generally at the mercy of that market, whether it's the stock market, whether that's the cash market, holding money in cash, whatever it is, whether it's even in gold or other commodities, there's a marketplace where you're really at the mercy of the pricing of the market, and that's the big challenge. So for those people who have money in those areas, usually there's not a lot of proactivity going on. We live in a house, our pension does what it does, we get the statement, we wished it was better than before, but it isn't, and then we look at our cash and we kind of go, well, I need that money for a rainy day, and here we are, it's raining every day. So most people are not really paying attention to that, but there are some things you can do, Chris, so it's definitely worth talking about them, because it's an easy place to start. It's often the easiest place, because you don't have to learn anything new. You just have to make a distinction or two that you can use in those pillars. So, and lots of our members and those participating in our debits challenge, Chris, new people to us often will tell us what they're doing. So, you seeing any evidence of what people are doing with their homes?
Well, obviously, at the moment, with the increase in interest rates every single day, we're certainly seeing people now fixing in those rates, speaking to their brokers. And of course, for anyone who's got a mortgage term that's coming towards the end of the last 6 months or so, they can actually go to their brokers now, can't they, and lock in some of those lower rates rather than waiting until that expires.
You can, in a place where the marketplace has got some stability. And I think with the government messing around with interest rates, or messing around with the economy to the extent that there's some confusion, isn't there, between the Bank of England's strategy to keep inflation down and then the government's sort of uncosted package in the UK as they presented that. And because it didn't have the sort of fiscal responsibility of being properly costed and tested and shown to the market got all jittery, and consequently interest rates got pulled very quickly. And I think some stability will come back to the market. So definitely look out for, if you're worried about fixed rates, and there's pushing now 2 million people in fixed rates in the UK. That's a massive percentage of the overall marketplace, the mortgage audience, if you like. Then as soon as you can lock in, the better. But the real danger, Chris, and which is why it's important to know, that lots and lots of first-time buyers in the last few years and others will be coming off fixed rates in the sort of twos, and we'll be starting to see fixed rates in the 5s and 6s, and maybe even more than that. But the point is, if your mortgage rate's going to double or triple or worse, you've got to be doing something. Otherwise, if you don't, your cost of living just simply, cannot improve, and that means you can't really build your wealth unless you're doing something proactive. So there are some things other than fix the interest rates, many other ways and things you can do. So any individual idea could work, from as simple as, they've still got the rent-to-room scheme, right, which is $7,500 a year, completely tax-free. We're not saying go get lodgers, everybody. Of course, that wouldn't make sense if you're living in a home and you don't want to do that. But that's an option. Connecting your money, any money that you've got in your business, in your personal life, you can connect that to your mortgage through offsetting, if that could work for you. I mean, there are many, many examples of creating some value, some income from the home, or doing something to proactively reduce or eliminate debt in some way. And we talked also, Chris, about transferring it to a business. So I would say anybody who wants to get some ideas, just tune into the debits rather than us give everything here today. But a word about the first-time buyers as well, Chris. I think people trying to get on the property ladder going, oh no, woe is me. It's a real difficult time for that. It's a real tough gig, isn't it? So one of the ways to think about that is to look up and down the generations. There are parents who perhaps have benefited from the long-term property inflation. People like me with houses and no mortgages, you can tap in to those properties and parents can help. But instead of borrowing from the bank at 6%, you could borrow from your parents at a much lower rate potentially. So there's all sorts of different ways that families can get together and create opportunities, as well as maintaining the security, and more of that in Wealth Builders for Families as we really get into a deep dive in the nitty-gritty of what's going on there, Chris, with banker mum and dad and how to deal with that. And perhaps if anybody listening, Chris, got a strong family, they do talk about money, or they're willing to talk about money, perhaps you could signpost the waiting list for Wealth Builders for Families, because we think looking up and down the generations is a real positive way to make family money work more effectively to beat the market, rather than let the younger ones suffer at the mercy of it.
Yes, absolutely. We're still developing the program, and if you'd like to be involved and give feedback and be one of the beta testers, then head to wealthbuilders.co.uk/families and pop your details in there, and we'll keep you up to date. So, Pillar 1, home capacity there, Kevin, we've touched on. And of course, there's a bit of extra good news with obviously the change in the stamp duty for the first time buyers as well now. So that's a bit of help for them. Yeah.
Definitely good help. I think it's up to 425K now instead of 250. So, that's a little bit of help. It doesn't help you with your repayments, but it does help you with getting on the ladder in the first place. So that's a positive thing. So I definitely I'm pleased to see that one come through.
Yeah. Okay. Pillar number 2 is pensions then. So obviously with the markets a little bit in turmoil recently, that means pensions will be going up and down as well.
Well, pensions always go up and down, don't they? That's the very nature of them. But I think as we think about pensions, it's the mainstay of retirement planning across the globe. And the big challenge we had in the UK, I don't know if this was noticed by many, there was a massive problem with the security of some of the biggest pensions, where the Bank of England had to come in and bail out a large number of pension funds. And that's an interesting point, Chris, because it goes under the radar because it's kind of highbrow macroeconomics and not necessarily reported too much. But that scared, definitely a language I could use, but it definitely scared me a lot, because so many people think their pensions are safe. It's like, my pension, in the box that says this is what I'm going to rely on when I get into my later years, whether it's 60s or 70s or whatever it is. But of course, your pension's only safe as the people running it. And if the government's having to bail things out, what if they didn't? Then your pension that you think is under control is not under control. Your pension's only safe if you have got so many safety mechanisms around it. So I think I would encourage anybody to go and take stock of the pensions they've got, for a number of reasons, not least to check, was your pension recently embroiled in the bailout? And what would that mean if economic situation worsened? Could your pension actually be at risk? And we've seen pensions go bust, Chris. So people who thought their pensions were safe are not safe. So you should check. Secondly, of course, when it comes to pensions, we know, Chris, how much money is just lost out in the pension ether. 10 billion of personal pensions and another 10 billion, give or take. That's huge sums of money in occupational pensions, where people work for a company and then just lost track. And the process of finding money isn't impossible. That money can be repatriated. We try and help people do that, and there's a tracing agency, isn't there, in pensions.gov to help people do that. And they can always reach out to us, Chris, because we've got a team of people who try and help people understand what their pensions are, what their charges are, what they can do, what they can't do. So taking stock of pensions is a very, very key thing. And I always jump on the soapbox about fees when it comes to pensions, because given that generally opaque, most people have a pension and then they let it kind of be part of their life, but they're not actively involved with it. They're not taking any proactive steps at all. I mean, how much time, maybe just a period of reflection here. If you're a listener to this now, how much time have you spent in the last 9 months, let's say, during 2022? How much actual time have you spent looking into, evaluating, and checking the value for money of the pension you've got? A minute? No minutes? Have you done anything? And I would say it's really critical to do that, because once you understand the fees and the huge damage that fees that are just unchecked, unasked, and you find out the typical fees in the UK about 2%, and that means it's about a third of the expected return. Now, if you're paying somebody a third of your money, you kind of want to make sure you're getting value for money. And I think so many are not. So we reach out and challenge people to find out their fees, and we certainly will help many. to reduce their fees by at least 50%. And with inflation running so high, if somebody can offer you a 50% reduction in your fees, I'd definitely take somebody up on that. So maybe you could signpost that, Chris, because pensions seems to be the area of life that people think they're unqualified, that they somehow feel somebody else knows better. It's just money. It's just in a wrapper, and the wrapper gets opaque. And because of that, it is so opaque, people think that somehow there's almost like a box where they couldn't possibly understand what's happening inside the box, when in fact it's remarkably easy. So I would definitely signpost that, Chris, and ask anybody to go and check what their fees are, and just see what they think about them, and either renegotiate them and say, well, I'm not happy with these fees. Will you charge me less? Otherwise I'll go somewhere else, which means you've got to do some research on where else would you go. Or alternatively, if you can, you could move that to your business. So it's a business deductible expense. So it's not coming out of, your money, it's the company paying. So it's tax deductible, where it's, not tax deductible in terms of the fees anyway, generally speaking. So lots of things to do with pensions. And of course, Chris, we know that for the most part, we've helped thousands of people who are being more entrepreneurial. And of course, as we get onto the other pillars, which are about being an entrepreneur, there's that special kind of pension we talk a lot about called the SSAS, or the small self-administered scheme, a pension scheme for directors of businesses, really, that puts them in complete control of what they invest in and what the fees are. So we'll never tire of that one, Chris, because it's such a major aspect of the wealth in the UK. And, I don't apologize for repeating this message, because we've seen that sometimes when people look at the kind of SAS pension, they get a bit overwhelmed and confused, because it's more complex than doing nothing, right? Doing something is always more complex than doing nothing. But it means that you have to spend a bit of your time. And if you've spent no minutes, and then all of a sudden we're asking you to spend an hour, 60 times harder than if you'd spend a minute. So, you do have to be willing to do something, and that doing something starts with just investigating, which is really, really important to do that.
Yeah, and please do reach out to us. We're always at the end of the telephone or an email if you need some help and you want to discuss your pensions with us. Drop us an email at hello@wealthbuilders.co.uk, and we'll be more than happy to arrange a call with you.
Yeah. So anyway, there's always something you can do, Chris. Not something you just lament and go, "Oh, woe is me." You can do something, and that often starts with just getting a sense of the fees and the value for money. You do that in life, so do that with your pension as well.
Okay, pillar 3 is investments. So
it's pretty much the same argument as pensions, because it's just it's often an over-reliance on the stock market in some form, whether it's wrapped a little box, whether it's a pension or a box is an ISA or a box is something else. There are always boxes, and of course the cash box has been pretty lightweight recently, hasn't it, with interest rates so low? But interest rates on the rise, cash is the opposite now, isn't it? That's getting some returns. I've seen some in the 4s now. Premium bonds have increased their prize pot. So, and remember the offset. So if you've got a mortgage of 6% and you're offsetting, you're basically getting 6% on your money. And you can use money you've got in your life to help reduce your overall costs, or you could use that money to start to build other assets. And as you've got spare money, build an emergency fund, obviously. Once you've got that to the level that you want, then start planting seeds, whether that's, starting to look at being an entrepreneur, starting to look at being proactive, and maybe even getting some education in that regard, because you cannot become wealthy with the same level of knowledge that you've got now. It's impossible.
Right, let's switch it over to the entrepreneurial pillars now then, Kevin. So again, if we were looking at that sheet of paper, those traditional pillars on the right-hand side, but on the left-hand side, we've got pillar 4, which is property portfolio. So properties, obviously, that you don't live in, that you can generate an income stream from. Pillar 5 is business, so creating any kind of business. Pillar 6, intellectual property. and pillar 7, joint ventures. So what's the difference between the entrepreneurial pillars, Kevin, and traditional pillars?
Well, a number of differences, Chris, and definitely worth repeating this. The first one is whenever you're taking steps to become more entrepreneurial, then you are being proactive as opposed to reactive. And that's the first thing. So in other words, you're getting involved. Number two, that involvement, if coupled with good education, allows you to add more value. So you become the wholesaler again now. You become able to determine things. You become more able to add value. You become the value adder as opposed to you becoming the value watcher. So you watch in pillars 1, 2, 3, you participate in 4 to 7. So you're able to add value. And the other aspect of that is you get an income stream, which you can identify and you could name it specifically. So generally, when you're in a home, there's no income stream. You live in your home. Generally, when you've got a pension or an investment, there's no income stream. It's a value. My pension's up or my BISA's up. It's up or down. It's the same. There's no inherent income stream. There's no income you can say, I'm banking this income stream. It's a capital value, and you hope to be able to take income from that capital value as you get older, which fundamentally is quite weird when you think about it. You want certainty of life, you want a certainty of income, but you're trying to almost scrape an income or draw an income from a well of an uncertain pot. It's a really, really difficult job to do, and that's why we encourage people to think about cash flow and income. So pillars 4 to 7 generate flows. That's really important because that's the flow of income. So in property, the flow, generally speaking, Chris, is rental income. And if you're generating rental income, it's not linked in the same way to the value in the stock market. So stated differently, if you've got 100,000 in the stock market, your value, and say you got 6%, minus your fees at 2%, you've made 4%. That's you. In the property, you've got two aspects of that. You've got the capital value of the property, which can hopefully increase over time. We know property values go up and down, but they, generally speaking, have a trend up. And you've got the rental income. So even if the capital value falls, stock market falls, say property values fall, doesn't mean your income has fallen. Because if property values fall and you've rented the property out to a tenant or a different type of tenants, then doesn't mean your income is going to go down. So you've almost decoupled the relationship between the capital value and the income value. And I think that's quite a critical aspect of property, which is why it's probably the most popular starting pillar as people move across the bridge, the Rubicon, as it were, from being on the traditional pillars to the entrepreneurial pillars. And of course, what's great about that journey is the pension can play a role in that, particularly as people discover SSAS can buy property or invest in property or facilitate property. So there's a real strong link between the pension and property. And the rental income then, and sometimes capital value can flow as well. And you can get debt leverage. So as long as you're making higher returns than the cost, then you're turning the cost of debt into an asset, because instead of say £100,000 worth of stocks, you could control with the same 100,000, maybe £300,000 or £400,000 worth of property, which then, if that gives you a 6% rental yield, gives you 24,000, where you don't have the fees, of course, that you're not paying 2% to anybody unless you're engaging with somebody to manage those, and that's for you to decide, but nobody else can decide that. So I think the real value is the leverage, it's the added value, it's the way you can proactively participate. And of course, you've got the option always to raise capital from properties you own. And by the way, when you raise capital from properties you own, that's tax-free income. You know, if your properties go up in value and you take a remortgage on the property and you take that money out, that's money that's in your bank that you don't have any tax to pay on it, because it's not an income stream, it's a capital value. And there's no CGT, no capital gains tax, until you sell the property. So there's so many different ways that property can bring value into your life. And so many different property strategies, as we know, Chris, probably best part of 20 different ways property can come to life. And we encourage people to start just to explore those gently. And again, back to community, Chris, the more you've got a sharing community around you, the more likely it is then that you can see things that you would never discover on your own. And that's a key point about this as well.
And in fact, all three of those traditional pillars can act as the fuel, can't they? Because we've seen many of our members who release money from their own properties to then be able to buy investment properties. And of course, from the investment pillar as well, if there's cash or investments that are not earning such a great percentage, then perhaps they can transfer that elsewhere. Yeah.
Quite right. Yeah. And we're not saying transfer your money from one to the other. We're saying you could do a portion of it, which means you're building your wealth in all of the pillars, or as many pillars as you can cope with. And that's an important point, Chris, about overwhelm that you just dropped in there, which is, I said at the beginning that sometimes it's difficult in markets to know what to do because well, I don't know about you, Chris, but in recent weeks, I think we've been overwhelmed with information. It's been a deluge of information, and that sometimes means it's difficult. If you don't spend very much time in your life looking at financial issues, it can just blow you over. And therefore, you don't do anything because it's just too confusing what to do, which is why I think making decisions in isolation, making decisions on your own is a difficult one. And that's why I encourage anybody to find a community of ethical people, sharing people willing to help and people willing to do so in a way that you feel the integrity of that. And I look out for those communities, and certainly Wealth Builders is one, but there are other communities too. So find a community, find people that you resonate with, and get involved and see what other people are doing, not in some sort of blind way to follow, but to get those distinctions that other people have. And then, find a way if you can. And if you need help, you can get a coach, you can get a guide, you can get a mentor, all possible, depending on the complexity of your situation, to help you kind of cut through the noise and start making some real important decisions. Because we believe most people can get to a place of financial independence in about 5 to 7 years, Chris. And therefore, you're going to need some help along the way. So try and seek out communities where you're going to get some additional value. And often, therefore, it means you're getting an educational value at low cost or sometimes even free.
Pillar 5 of our entrepreneurial pillars is the business pillar, one of your favorites, Kevin, I know. And you talked about with property, obviously, the flow of income is the rental income. With a business, I guess it's profit. It's
profit, yeah. And the profit in business is not linked to markets, because this is where you can move from being wholesale. Largely in property, when you're getting into it, Chris, you're moving from retail to wholesale because you're starting to add value, you're starting to understand that. It's only when you get the distinction to be outstanding in a niche can you become a creator, when you create your own value, where you're so good at it, you're creating opportunities that other people just don't see. Value in business for me is the ability to serve a community, to serve a customer, to serve a member. And you can become a server in a way that means you're making those distinctions about how best to help that community, and you can generate a return for them and a return for you in an ethical way. That means you're building profits. And if you can do that on a recurring basis, and what I mean by that is the income and the value recur together, which means it's an ethical win-win. And that's why I like to do it, because it says, how do you constantly add value to the end user? And as long as you keep focused on that, they will favor you with their membership or their subscription or whatever it is. So I'm a believer in business that doesn't trade a service for money like a contractor or a service provider or a product provider trading a product for money. It's trying to create recurring income from business. So I would qualify the business pillar, Chris, is can you create a recurring income from the business you've decided to be in? And that's a whole world of difference from being in business, which is providing a service or providing a product for a profit, because that's not recurring. So therefore, you cannot reliably bank on it. You can't reliably sell it. And of course, the value is severely diminished when everything depends on you. So the skill of moving from self-dependency, time dependency, service or product dependency into being able to create streams of recurring income from business. And anybody interested in that, Chris, we talk about the 4 different ways that you can create a recurring income and the really important things that you need to do to build a business with recurring income. How would people find out about that if they're in business?
Well, that's certainly an area that we cover for our members inside the Wealth Builders Academy. So yes, certainly do, find out more about how we work with people on the recurring income side of business. Head to wealthbuilders.co.uk/academy for more information.
Yeah, I love that part of it, Chris, and I love running the workshops to help business owners. So you need to have a business. We don't really help too much if you're thinking about business. It's not a business yet, just an idea. But those people who have businesses, you can definitely change from being dependent on time and service for money to gradually moving towards increasing the recurring percentage of your business from 0 to 1% to 5% to 10% and ongoing from there.
Yeah, and we've seen the government helping business owners as well with obviously the kind of change for the corporation tax non-increase as was planned, which is very welcome, and also the cap on business energy rates as well recently.
Yes, so good opportunities to be in business, and definitely some ways where if you've got some personal expenses, remember you can transfer those costs to your business, so they move from being post-tax to pre-tax. Not everything can be done, and of course you've got to take good guidance to make sure what you're doing is legitimate, but certainly some legitimate things we know for sure are switching your life cover from personal life cover to business. Similarly, your pension costs can move from being a personal cost to a business cost through the concept of the directors only SSAS pension, and many other ways that you can transfer costs. I mean, you and I, Chris, are both drivers of electric vehicles, aren't we? And that's a cost you can deflect and transfer to a business. But your business, the other thing I've noticed, Chris, as I speak to businesses every day, they've often, in times of trouble, they store up the money in their business bank account. That money as a separate legal entity can be used to build wealth. You could reinvest that money in any of the pillars. So you can turn money that's in your business, you can turn that into property, you could turn that into IP, you could turn it into pension, you could turn it into joint ventures. This, as we discover those things, maybe we'll just touch on that and see how business owners and different age groups can tap into that. So, and of course for the younger people, Chris, I know you're signposting Wealth Builders for Families. I don't know about you. Did you miss the lesson, in school that said you could be an entrepreneur? I mean, did you miss that one?
I think so. I don't remember that one.
Yeah. And then when I went to university, I missed that one. I was looking at, maybe I signed up to the football club and didn't sign up to the entrepreneurs club. But the whole point about this is, we've got to help our younger people think like entrepreneurs. And I think it starts with wealth building families who then encourage their children of all ages to participate and to learn how they can be value adders themselves. So I'm saying try and get wherever you can, and we will be having loads of case studies in the Wealth Builders Families program. But we'll have, but you might already now be showing your children what you're doing, letting them see the pillars you're building and how you're building them, and give them an opportunity to participate in some way so they can add some value. And who knows, that adding value could turn into earning value. And if you're doing that, then you can legitimately pay them in your business. And we cover that in the academy as well, from different ages to what you can do and what you can't do for children of all ages, actually. So interesting to start to see all of this. There's so much to do, but you can involve your whole family, so you're getting enjoyment and leverage, and you're building a real wealth plan for the whole family and for the future, not just for today.
Yeah. Our sixth wealth building pillar is intellectual property. This is really understanding your own value. And for some people, Kevin, now, perhaps been in a corporate working life for a long time, looking perhaps at the next phase. And often we overlook the value that we've built up over many years.
Unquestionably so. I think it's second to pensions, which is the most overlooked. I think the IP that sits below our very feet, often said there's a mountain of value below us that we overlook when we're seeing something else. We're looking around us for the opportunity, but the very IP we've created from our experience, from our time served, from the things we've done really well, for the things we've learned we don't do well, you're shaping your own intellectual property, and you can bring that to bear in your wealth building journey. So do what, which is where the wealth dynamics thing comes in, Chris, as well, isn't it? So learning yourself, learning how you think, learning how you process information. So take stock of what you've done and see where you could bring that value into building property, building business, or creating joint ventures. And so many of our members go on to more formalize that IP through courses and programs and books and downloads. You can start anywhere, really, even if it's you're doing property and you're building the story of how your property business is growing. I mean, you're starting to form your IP because you're building case studies, your befores and your afters, the people and the team that you're building, the relationships that you're forming, all of which is IP. So I'd say for anybody, be like a kid again. Start keeping a diary, start keeping a journal of who's now in your life, what you're doing, what lessons you're learning, what distinctions you're making, because in a whirlwind, you often overlook those. But later on, when things are quieter and you've managed to calm your own storm because you're more in control, you're building your own pillars, then you'll have time to properly create your IP, which will leverage your returns still further, because that gives you authority to share information so you can create recurring income from IP in a way that as you're starting, you're not ready yet. You're not ready to teach it. You're ready to learn it, but the student then becomes the teacher. And when you're in that situation, you've genuinely created IP that has value.
And this actually can lead into our final pillar, pillar 7, joint ventures, because we've seen, again, many examples of our members who have been documenting what they've been doing throughout their journey, creating websites, creating videos that are now on social media. And that, of course, attracts people towards them, and that can lead to potential joint ventures.
Yeah, and joint ventures can be both outward and inward. You can go out and seek joint ventures, which means collaborating with others for purposes of profit and ideally for a recurring profit. So again, we're talking about, by the way, Chris, we forgot. So the portfolio of properties rental, the business's profit, the IP can be any combination of those, but also could be royalties, Chris.
That's right.
And,
yes.
We like the sound of that one, don't we? It almost bears repeating, doesn't it? Royalty. Yes, we like the sound of that. So you can create royalties, so you can create royalties, profits, so IP is multidimensional. And joint ventures, likewise, you can create many ways to establish an income stream flowing, whether it's a collaboration with somebody else for shared profit, whether it's you become a bank, you take some of the money you've got, and instead of perhaps you don't have the time or the inclination to be the doer, you might become a banker and you're funding people who do. Now, subject to doing all the right, proper, rigorous due diligence, all of those things are possible, Chris. And I know that's some of the ways that I make my own capital appreciate and work, because smart people who I get to meet, finding their niche, and I can follow the niche. I don't have to be in the niche. I can just understand it, follow it, take my own due diligence approach to it, and bring funding to a table that they need, because anybody who's doing property, for example, or business, often will run out of money before they run out of ambition. So being a collaborator and being a banker in that regard can be helpful both to them and to me. So another way you could do that as well.
Okay, so we have covered off 7 different ways there that you can focus on to build more wealth in your life. And as we said at the beginning, small steps. So don't get overwhelmed. Choose one. We all say
Choose one, yeah.
focus on a primary pillar, maybe a secondary pillar. Allocate your time accordingly, but take small steps every month. Always be doing something to build your wealth every 30 days, as you say, Kevin.
And that's an important point, Chris, I think, because sometimes when you're listening to a podcast or you're watching the news, it's still the deluge, isn't it? So find one thing, you know. So like, even if you just use the 80-20 rule and go, okay, what's the one thing I'll put 80% of my attention to? But then what's the second thing? Because you want to build the diversification in your wealth. You don't want to be caught up. It's dangerous. To one of anything is dangerous, you know. So you don't really want to be just on one pillar. You want to always have something else to balance it out. And then once you've established your pillar, your primary one, if it works, then you're building your security, you're moving towards independence, you start to build other pillars around you. So just find the one idea that you resonate with in this podcast or other podcasts and do something about that. And once you've done that, chart it, write it down, you know, celebrate it if you're getting a result, and people can keep a record of that on the wall chart as well, Chris. So there's lots of ways that we try and make it easy and visual for people to keep control over what they're doing. Or, you know, join the program and get a coach and tell the coach every month what you're doing. So instead of you holding yourself accountable, and maybe you don't do that from time to time, having somebody who can hold you accountable, following a plan that works in all economic circumstances, then maybe that might be the right thing for you. Or just continue to enjoy what we give for free, Chris, because at some point, we hope that you'll kind of move towards us as you want to know and expand your wealth still further.
Yeah, we shared lots of different ways that you can connect with us today, whether that's just reaching out to say hello through email, or finding out more about the Families Program, or, as Kevin just mentioned, being part of our Academy membership there. So the first step is always just join us for free, follow us for free, share this podcast if you've enjoyed today's episode and you think someone else could benefit from that. We would really appreciate it. And Kevin, I think we'll wrap up this week's episode and bid each other farewell, but we'll be back same time, same place next week.
Yeah, it's a bit of a whirlwind, Chris, and a little bone to pick with you. You didn't share a review today. And normally you do that. So why don't we save that for the next time? Because we just want to concentrate on adding value today. But until then, my friend, see ya.